Welcome to the deep dive. We are thrilled to have you with us today.
Yeah, we really have a fascinating one lined up.
We do, because we are looking at something that might just fundamentally change how you view the world around you.
Absolutely.
Let me start with a slightly jarring question for you. What if everything we've been taught about free markets and fair prices actually violates the fundamental laws of physics?
It is quite the hook. And to answer it, we're going to be unpacking a highly uncomfortable truth today.
Right.
The sources you've brought us explore this radical economic framework called vector field theory, or VFT. We're looking at a pretty fascinating stack of documents.
Yeah, primarily there is a formal academic paper titled The Universal Force Equation of Price.
Which essentially attempts to bridge the gap between economics and physics.
Oh, exactly. And accompanying that paper, we have two incredibly detailed breakdown models. They're known as the reality tensor error matrix and the reality tensor debt matrix.
And our mission today is to unpack the core thesis hidden inside these mathematical models. Because when taken to its logical conclusion, this framework argues something huge.
It really does.
It argues that what orthodox economics casually calls profit is often mathematically proven to be a signal of extractive behavior.
We are talking about the literal extraction of resources above their natural replacement or procurement rate.
Yes, it frames this as a thermodynamic deficit. And the wildest part is the assertion that this deficit inevitably must be replaced with debt.
It's intense. The framework basically states that our modern pricing mechanisms are broken. They completely ignore the physical boundaries of the ecosystem we live in.
Because traditional models optimize for localized short-range desires, but ignore the long-range structural costs.
Right. So we are going to use the math in these sources to redefine price. It's no longer just a simple graph of supply and demand. It becomes a thermodynamic equation.
I think we should start with the error matrix from our sources.
Let's do it. It grounds this dense theory in something we intuitively understand.
Right, because one of the classic problems in orthodox economics is that it struggles to price things that are universally abundant, like the air we breathe.
In vector field theory, they use two primary metrics: scarcity, which they label as S, and urgency, labeled as U.
And when scarcity and urgency are near zero,
Like standing in the middle of a forest.
exactly, the price of air is just the natural work required to breathe. It is literally just the caloric effort of your lungs. Simple enough.
Simple enough unless you're me in high altitude, in which case that caloric effort is significantly higher and involves a lot of wheezing.
Fair point.
Yeah.
But to test the math, the sources introduce a scenario they call the S4U4 anomaly.
The sinking ship scenario.
Yes, it serves as a perfect stress test for the theory.
Before we get into the scenario itself, let me make sure I'm reading the scale correctly. Later in the paper, it seems to imply the scale usually maxes out at 1.0 for a standard transaction.
Right, or 2.0 for absolute deprivation.
So what on earth does a 4 mean?
That is a crucial distinction. In this framework, 1.0 is the boundary condition for a healthy, sustainable system. And 2.0 represents an absolute biological failure, like starvation.
Okay.
So the 4 in the S4U4 anomaly represents a mathematical impossibility, or an extreme theoretical boundary well beyond normal physical reality.
It's pushing it to the limit.
Exactly. It is the framework's way of pushing the equation to its absolute breaking point to see if the math still holds up under unimaginable stress.
Okay, let's unpack this. Picture this scenario from the text. You are trapped in a sinking submarine. The water is rising.
Terrifying.
Truly. You have absolute agency. Your U parameter is maxed out. Someone else in that submarine holds the only emergency rebreather. They have absolute control over the scarcity.
Right.
And they look at you and demand your entire $5 million estate in exchange for that rebreather.
And standard neoclassical economics actually looks at this transaction and says, this is fine.
They call it equilibrium at infinity, or simply whatever the market will bear. Because you prefer living with $0 to dying with $5 million, your revealed preference supposedly proves the air is subjectively worth $5 million to you.
The market has efficiently cleared, they would say.
But vector field theory completely rejects that orthodox interpretation.
VFT argues that treating a life or death hostage situation as a free market, working efficiently, is mathematically equivalent to armed robbery.
Yeah.
The framework uses something called the Hostility Equivalent Metric to prove this point. If we calculate the fair price of that rebreather, the paper looks at the literal thermodynamic initiation energy required to deliver the good.
Let's do a quick translation for the listener there. Thermodynamic initiation energy.
In simple terms, it just means the actual physical calories, materials, and sweat required to make the thing exist and get it to you.
So it's the metal mined for the canister, the electricity used in the factory, the fuel to ship it.
And the human caloric energy used to hand it over. If we break that down, it's roughly $50 for the physical canister and gases. Maybe $50 for the physical labor and logistics of getting it into the submarine.
Plus a standard margin to ensure the system keeps producing them.
Right. The mathematically fair price is about $150.
Wait, standard economics would argue that the seller took on the massive risk of having that rebreather in the first place, or had the foresight to bring it. Doesn't VFT account for risk or foresight in that massive price tag?
Orthodox economics would indeed call that consumer surplus captured by the supplier, rewarding their foresight.
Right.
VFT, however, calls it moral debt.
Moral debt.
That nearly $5 million difference is unearned, stolen thermodynamic capacity. It is pure extraction.
Wow.
The seller didn't physically create $5 million of energy or value. They simply used the structural friction of the sinking submarine as leverage to extract your life's work.
What's fascinating here is that human beings instinctively map this reality tensor.
Yes, we do.
When we see someone charge exorbitant prices during a crisis, like someone price gouging bottled water during a hurricane, we universally call it daylight robbery or extortion. Our biology knows the math is wrong.
And orthodox economics dismisses those phrases as emotional or mathematically illiterate. But VFT formally validates them as rigorous structural diagnostics.
Your nervous system is detecting a massive unearned margin. It physically feels the theft because that moral debt is a real mathematical reality.
Which brings us to the central mission of our deep dive, redefining profit as extraction.
Yes.
According to the universal price equation we're looking at, there is a strict boundary line. It is called the max acceptable rate boundary, which sits right where scarcity and urgency hit 1.0 on their scale.
Let me see if I have the terminology straight. The paper says as long as you stay below 1.0, the transaction is exothermic.
Correct.
But the second a price pushes past that 1.0 threshold, the transaction flips into an endothermic state. Exothermic meaning it gives off energy, creating value for both people, and endothermic meaning it sucks energy out of the room.
You nailed it. Below 1.0, it is mutually beneficial. It produces and sustains human survival. Pushing past 1.0 makes it an extractive event.
And to understand why the math behaves this way, we have to look at how the formal academic paper frames the hierarchy problem.
In physics, you have the strong nuclear force, which is incredibly powerful but operates over microscopic distances. And then you have gravity, which is very weak but operates universally across galaxies.
Economics has a similar hierarchy. The localized, immediate desire of an individual is like the strong short-range force.
Right.
The diffuse long-term stability of the overall ecosystem is like gravity. Traditional economics only prices the short-range desire. It completely ignores the physical boundaries of the ecosystem.
You mentioned physics forces there.
Yeah.
Does the paper actually push this physics comparison further? Because trying to overlay physics onto human behavior usually gets messy.
It does. The paper draws a direct structural parallel to Einstein's theory of relativity. Yeah. In physics, we have the famous equation E equals mc squared, where the speed of light squared is a hard, non-negotiable physical limit.
You cannot negotiate with the speed of light. The universe simply doesn't allow it.
Exactly. In this economic framework, they replace the speed of light with the reality tensor.
The reality tensor measures the fundamental physical state of a resource. Its scarcity, its renewability, its rarity.
It acts as an immovable boundary condition for any given market.
Well, let me make sure I'm getting this. Are they saying that if I charge someone significantly more than the thermodynamic energy it took to make the good, I'm basically violating a law of physics?
Yes.
I'm extracting more than can be replaced.
That is the core assertion. When you push beyond that reality tensor boundary, profit is no longer signaling value creation, it is signaling extractive behavior.
You are draining the systemic capacity of the other agent.
Because the reality tensor is a physical limit, that deficit doesn't just vanish into an abstract spreadsheet. It is a thermodynamic violation. Energy was destroyed or removed from the local system faster than it can be regenerated.
I want you, the listener, to think about this in your own life. If someone or some system drains your financial or physical capacity faster than you can naturally replenish it through your own labor, what happens?
You don't just magically disappear. You still have to pay rent. You still have to buy groceries to fuel your body.
You have to plug the hole somehow.
Which leads us perfectly to the next major concept in our sources, the debt matrix.
Because extractive profit drains the victim's thermodynamic capacity, that drained capacity must be replaced with debt just to survive. The system demands balance.
Here's where it gets really interesting. The reality tensor debt matrix is actually presented as the exact inverse of the air matrix.
How so?
With air, abundance is cheap and scarcity is deadly. But with debt, it operates with an inverse moral valence. The sources point out that debt at maximum abundance and zero urgency is actually a net benefit.
Right. When capital is abundant and a borrower has zero urgency, say a thriving company making a strategic decision to expand a business, debt is a productive multiplier.
The price of borrowing is just the natural work of administrative friction, and the borrower profits net of that cost. It operates well below the 1.0 boundary as an exothermic, value-creating tool.
But just like the air matrix, when scarcity and urgency spike, the math completely breaks down. Let's talk about the extraction trap.
The sources use the example of a payday loan to illustrate this.
This is where we see the transition from a standard transaction to a hostage situation. Imagine a borrower facing a terminal financial emergency, an impending eviction, or a sudden medical crisis.
Their urgency parameter is maxed out.
They approach the only available short-term lender, so the scarcity parameter is also extremely high. The lender offers a $1,000 loan for 30 days at a 400% annual percentage rate.
Standard economics says, hey, the borrower agreed to the terms, they signed the paperwork, and the market is efficiently pricing the severe risk of default on an unsecured loan.
But VFT calculates the actual thermodynamic fair rate of that loan instead.
Right.
The lender's actual physical administrative cost, the server time to process the application, the fraction of an underwriter's hourly wage is about $20.
We add a generous $15 risk premium based on the genuine statistical probability of default across the portfolio.
So the fair thermodynamic cost to provide that service is $35. But at 400% APR, the lender is charging roughly $330 in interest for that single month.
That means $295 of that transaction is pure moral debt.
It is unearned thermodynamic capacity extracted from a person who is already in a severe energy deficit.
This highlights the thermodynamic violation of compounding interest, which the formal paper breaks down in incredible detail. Compounding interest inserts a recursive mathematical function that demands continuous exponential growth from the borrower.
But human beings aren't exponential functions.
Yeah.
We have physical limits.
We need 8 hours of sleep. We have a maximum caloric output.
How does the paper reconcile an infinite mathematical curve with a finite biological being?
It doesn't, and that is the point. While orthodox models defend this as the time value of money, the VFT paper proves it is a thermodynamic impossibility.
You cannot force an exponential compounding curve onto a finite biological being living in a finite physical reality without causing a systemic rupture.
The math demands that the borrower export continuous localized disorder, taking on second jobs, sacrificing sleep, deteriorating their health, to service an abstraction that has no physical limit.
Eventually, the required escape velocity to clear the debt exceeds the total caloric and economic output capacity of the human being. The system breaks.
Okay, but a sinking submarine is a freak accident. Does this happen daily? Are people really trapped like that in the normal economy, or is this just theoretical modeling?
The sources are very clear on this. It is not an accident. They introduce a concept called the smart selfish actor and the perpetual problem machine.
If you want to extract maximum wealth, you can't just wait around for an emergency to happen. You have to actively manufacture scarcity and manufacture urgency.
And to understand how this works in reality, the formal paper introduces something called the Lorentz haggling transform.
It borrows the Lorentz factor from special relativity. For a quick physics refresher, the Lorentz factor calculates how time and space physically distort as an object approaches the speed of light.
In VFT, they adapt this to calculate how prices distort as relative bargaining urgency approaches its absolute limit.
Now, as we dive into these real-world examples from the sources, we want to remind you that we are impartially reporting the framework's mathematical analysis here.
Yes.
We aren't taking political stances on capitalism or regulation. We are simply explaining how the math applies to the data sets provided in the paper.
Let's look at the housing crisis through this lens. In major metropolitan real estate markets, we see nominal property prices totally decoupled from local median incomes.
Orthodox economics tends to blame generic supply and demand imbalances.
But the reality tensor isolates the algorithmic distortion. Highly capitalized entities, like sovereign wealth funds or massive private equity firms, capture high volumes of residential real estate.
Because they have virtually unlimited capital reserves, they can afford to hold properties vacant.
And by holding them vacant, they are deliberately spiking the scarcity metric, the S parameter, in our local ecosystem.
Furthermore, land is geographically constrained. You cannot simply manufacture more land in the middle of Manhattan or San Francisco.
So the rarity metric is naturally pushed toward its absolute limit of 1.0. When rarity hits 1.0, the mathematical denominator of the reality tensor collapses.
In calculus, when a denominator approaches zero, the result approaches infinity.
At the exact same time, the institutional seller has zero urgency to sell or rent, while the buyer's biological need for shelter pushes their urgency to the maximum.
This massive difference in relative velocity creates a Lorentz amplification. The mathematical result is an infinite price trajectory. It is the signature of maximum structural extraction, not an efficient market clearing.
Think about how that actually feels to a renter. You have a local worker, say a nurse or a teacher, providing real thermodynamic labor to the community.
But a massive percentage of their caloric output, their paycheck, is siphoned off just to secure a basic physical boundary from the elements.
The second case study from the sources is the insulin market. This is presented as a pure, distilled example of Lorentz amplification.
The biological manufacturing process for insulin is incredibly renewable. You are essentially fermenting yeast or bacteria in a vat.
The thermodynamic initiation energy is remarkably low. The reality tensor says this should be incredibly cheap to the end consumer.
But the Lorentz factor completely overrides the reality tensor in this scenario.
A type 1 diabetic has an absolute biological deadline. Their window of opportunity to acquire the resource is rapidly closing, which means their urgency velocity is essentially maxed out. They will die without it.
Meanwhile, the pharmaceutical consolidator holding the regional patent has a monopoly, meaning scarcity is artificially controlled.
And the corporation has absolutely zero biological urgency.
The relative velocity between the dying patient and the corporate entity approaches the maximum limit. The Lorentz coefficient spikes to infinity.
The mathematical equation predicts that the probability of the buyer accepting the asked price remains pinned at 100%, regardless of how ruinously high the price is above the actual production cost.
The framework mathematically proves this is coercion masquerading as a clearing market.
The smart selfish actor doesn't just stop at one market either. The sources describe the perpetual problem machine.
If an entire generation is taught that it is normal to finance basic biological and social necessities, housing, healthcare, education, through debt,
They enter the lending system at a state of high urgency as their baseline starting condition.
the necessity was manufactured. The problem is engineered so that the solution, extractive debt, can be sold.
If we connect this to the bigger picture, the sources explain why this extractive wealth flywheel ultimately fails. It hits what they call the biological hard floor.
You can manipulate the matrices and the algorithms all you want, but you cannot manipulate biology.
At a certain point, the human body simply stops functioning.
At absolute deprivation, where scarcity equals 2.0 and urgency equals 2.0, the ideological framing of a free market simply collapses.
Hunger, homelessness, and asphyxiation are not market preferences. They are physical, biological facts.
The formal paper argues that when Orthodox economics says you agreed to the terms under these conditions, it is relying on a mathematical fiction.
When the population hits this biological hard floor, it triggers systemic ruptures. We see this historically as debt jubilees, debt strikes, and massive political upheaval.
The deception path fails because the involuntary biological response to deprivation cannot be suppressed by economic models.
So what does this all mean? We've gone on quite a dense journey today.
We really have. We've learned that under vector field theory, price isn't just a simple intersection of supply and demand curves on a graph. It is a thermodynamic equation mapping the literal energy limits of our physical reality.
We've seen the mathematical argument that profit driven by artificially restricted supply or desperate human urgency isn't wealth creation. It is extraction.
It's pulling resources out of a local system far above their natural replacement rate. And unchecked extraction always, mathematically, forces a society into unpayable debt traps and eventual systemic collapse.
Because you cannot force infinite exponential growth onto finite physical beings.
The primary takeaway here is to challenge how you view value in your daily life.
I encourage you to view the world through the reality tensor. When you look at the prices around you, whether it's your rent, your groceries, or the compounding interest rate on your credit card, ask yourself, is this price reflective of the actual thermodynamic energy required to create the good.
Or is it a measurement of the seller's leverage over your urgency? Are you paying for the air or are you paying for the extortion?
It is definitely a heavy perspective shift.
It is, but I want to leave you with a final provocative thought inspired by the source material. The academic paper mentions an algorithmic H-score, a hegemonic alignment score. It could theoretically be built into digital ledgers to automatically block financially extractive transactions if the math shows the relative urgency is too coercive.
That is a fascinating application of the tensor.
But what if we took that idea out of the financial markets and applied the H-score to our personal relationships?
Oh, wow.
Think about it. If an algorithm tracked the scarcity of your time and emotional bandwidth and weighted against the urgency of your friends' or colleagues' requests, how many of your everyday social interactions would mathematically register as hostile extractions of your thermodynamic energy?
That is a wild thought.
Are we unknowingly putting our loved ones into emotional debt because we are exploiting their urgency to please us? Are you running an exothermic friendship that creates energy or an endothermic one that drains it? Something for you to mull over until next time.
Thanks for joining us on this deep dive.